Hello, this is Richard Wilson. I'm coming to you from Malaysia today. I'm actually here in Kuala Lumpur to speak at a family office conference and meet with a few potential clients. And I wanted to talk to you real quick about what kills lower middle market deals. So I've been working on a lot of direct investment, co-investment activity on behalf of our buy-side clients. And there's a few things that keep coming up that just absolutely kill deals very quickly. And it's in nobody's best interest that these things happen. It's not good for my firm. It's not good for my clients who are trying to acquire these businesses or provide them with growth capital. And it's obviously not good for that family business founder, that multi-generational business owner who's trying to create a liquidity event or sell his business or grow it faster. So here are the things that quickly kill lower middle market deals. One is basing your valuation on a multiple of revenue, on something based on IP or technology, instead of basing it on your EBITDA numbers. In other words, if you try to say, well, we're doing $5 million in revenue, and I see that this $100 million a year in revenue company got valued at a 2 times multiple of their revenue, well, that's not relevant because first of all, you are not at $100 million a year, and second of all, anything that's less than $50 or $100 million a year is almost always going to be an EBITDA multiple, especially if you're working with family offices. They don't have to allocate all their capital like a pension fund, endowment fund, or private equity fund might feel pressured to, and they can wait for great deals. So they're not going to overspend. Of all the clients we represent, nobody is looking to spend more than 7 times, maybe once over 10 years, 8 or 9 times EBITDA, but really the 3 to 7 times EBITDA is the range. And the larger your business, the more professionalized, the more systematic, the more that the current CEO founder isn't needed to run it day to day, then the higher multiple you deserve as a business owner. The industry, the life cycle of the business, how competitive the environment is, how stable those earnings will be going forward, all change what the multiple could be. Now let's get back to other things that kill deals. We've had multiple deals killed because of excess debt. The first deal we started working on was killed because of kind of off-balance sheet holding company activities or kind of third-party holding companies that the CEO was compensating himself through. The valuation was already high, and then once it was uncovered that he was compensating himself through some third-party entities, we had to walk away, and our broker-dealer and I just decided it just wasn't worth really, working with an organization like that because we couldn't trust what else was going on since that wasn't really disclosed up front. And a lot of the time, deals breaking come down to not trusting the team or not trusting the financials, which gets to my next 2 points, which are just a completely disorganized business in terms of financial systems or just operational systems. If you can't trust that the EBITDA and the revenue will still be there the next year without that CEO working 60 hours a week, then it's a nice craftsman business, but it's all in their head, and it's not really something that can be managed and grown institutionally, at least not very easily from where it is now, and it can bring down that multiple by a third or a half sometimes. If the financials are all out of mess, you can't trust what the CEO tells you. He might not even have a lot of conviction, or she might not, in what their revenue or net income or cash balance sheet actually looks like. So as a buyer, if everything else is excellent and their financials are a mess, that could be an advantage because once you clean them up, you might actually be in a decent situation. So you can kind of lean a little bit negotiation-wise into them and get a better deal, perhaps. But you're taking a little more risk because you don't really know what you're buying unless you get a forensic accountant in there and get some assurity of what you're doing. So those are the main ways that lower middle market deals get killed. I would say that the most important thing to remember is that lower middle market deals get valued on a multiple of EBITDA, not a revenue multiple. They don't care what the potential is. They care what you did last year. They don't care what you're projecting next year or the year after. They sort of do, but they don't trust it too much. Of course, you're going to think it's rosy. But just focus on what last year's EBITDA was and focus on a reasonable multiple there, and you're much less likely to blow up a deal if you're looking to raise capital, gain access to expansion or growth capital, or sell your business or create a liquidity event for your family business. So it's Richard Wilson coming to you from Asia today, and I'll see you again soon. Thank you.